Hello everyone, I'm Wildy Chia and welcome to my YouTube channel. So this is on working capital management part 2. So this is a continuation of part 1, and this is very relevant to students who might be taking this as part of their studies in the FIA program, the ACCA FIA program, in the subject of financial management, foundation in financial management. And it's also applicable to students who might be doing this for their F9 paper at the ACCA level. Right. Students who might be doing this for their degree will also find this relevant. Okay, so let's begin and go through this. Right. So in my first video, I already went through what working capital management is about. So in this video, I'm going to go through the more technical formulas used in deriving working capital cycle and working capital requirements. And going on is that, it's not complete until you understand how to interpret the results, right? So calculation is one thing, but interpreting the results and understanding what it means, what this means, is also important, right? We'll also look at how to apply the formulas in a simple example, right? So it's a short video, and I'll try to have everything explained by the end of maybe the 30th minute, right? So closing with the last point, which is assessing whether a certain amount of working capital is required for business, right? How much is appropriate, right? So we are going to see this, towards the end of this video. Your introduction. So our walkthrough in the previous video had covered the things on the importance and the purpose of working capital. So our focus in this video would be to discover or find out more exactly how do we calculate inventory holding, and also receivable collection period, and lastly payable payment period. The calculation is fairly straightforward, right? Now, what do we mean by inventory holding period? Basically, it refers to how long inventory is held. Now, the keyword is on average, right? So it's a rough estimation of the length of time that inventories are held. If you want to find out exactly how long is certain inventory items being held, then this wouldn't be very useful. Okay, so what is a desirable length of holding period? Now, the rule of thumb is that generally a shorter holding period is desirable, because it means that the business has its money, or if you like the other term, working capital, tied up in stocks for a shorter period of time. Now remember, the shorter the period of time that you have to hold the stocks, the faster you are able to take back the capital and reinvest that, right? So think about a grocery shop or a supermarket. The sooner that the vegetables can be sold, the earlier can the money be recovered and then used to buy new stocks, and then that new stocks can be sold earlier, and that means that the funds can be recycled faster, which is why shorter holding periods are always more desirable. But how short can this be? That really depends. Not all businesses have the benefit of very short holding periods. Like for example, furniture shops might find that they have to hold their inventories for a longer period of time compared to, for example, a grocery shop, right? So this really depends on the nature of the business. So not all businesses will enjoy the same, as I mentioned just now, the same short holding periods. Now, inventory holding period may be calculated, right, based on material holding, right? If you are looking at a business that is producing goods for purpose of resale, then material holding is one of those holding periods that can be calculated. Work in progress holding period, right? And the last one, which is finished goods holding period. Now, each one of them measures something a bit different. Let's go on to the details. Now, what do we mean by material holding period? It refers to the average time that materials are held. Now, imagine if you have a factory producing, let's say, maybe say for example cars. So then this factory needs to hold certain amounts of materials, right? So then how long should the materials be held? Okay, maybe a day, 2 days, 3 days, right, or whatever length of time that is. So, and this materials will have to be held until the factory takes and uses these materials to start producing the cars. So while these materials are still being held before the production process takes place, this is referred to as the material holding period. Right? How long these are held before they are used for production. The formula that we usually use to calculate material holding period is to take the, simply put, the average material inventory, divide that by material purchases, multiplied by 365. Now it can be 365 or it can be 52, depending on whether you want to measure this in days or measure this in weeks, but that doesn't really matter, right? So how do we interpret the material holding period? Basically, a short holding period is always desirable because with a short holding period, it means that the business has less funds tied up in inventories, right? A longer holding period is undesirable because there is risk that there is more money tied up in stocks. It also means that there is potential risk that the stocks may expire, depending. Certain goods cannot be held for long because there is expiry dates. Certain goods cannot be held for long because if you hold for too long, then these may suffer from deterioration, right? So some goods have to be kept for a certain amount of time. If you keep them for too long, then the physical condition might deteriorate. So there are many reasons depending on what kind of materials that the business is holding, right? So the general rule of thumb is that a short holding period is always desirable. But how short is desirable? Remember what I mentioned just now? It depends. Depends on the nature of the business and what trade it is in. What is it producing? Now, the work in progress holding period is basically a bit different. It comes after the material holding period. It measures the length of time that inventory is held, right, while it is being processed into finished goods. So that's what it means. The formula for calculating this simply is to take the average work in progress inventory, divide that by the cost of goods sold, or some people refer to this as the cost of sales, times the percentage of completion, and the whole fraction multiplied by 365, or like what I mentioned just now, or 52, depending on whether you want to measure this in days or weeks. Right. Now, there are quite a few ways to interpret this cost of sales. Like those students taking this in the FIA program, one way to define this is that it should be equals to material plus direct labor plus production overheads. So this really depends, right? So if you are taking this in the exam, then you have to identify whether there is any specific definition for this cost of sales, right? Okay. But if you wish to find out how does it work in your syllabus, then let me know. But as far as the FIA program is concerned, this is typically how exam papers will define cost of sales. The interpretation. How do we interpret? Generally, a shorter work in progress period is desirable, right? Like what I mentioned just now, the short holding period is desirable because it means less working capital tied up in inventory, right? And the funds can be used very quickly, once it's recovered from the stocks, to reinvest in new stocks. And new stocks can be produced. Now, if you have a short holding period, it also reflects one more thing, that there is efficiency in the production process, right? Remember, the longer that you hold the stocks, what does it mean? It means that potentially there might be issues with production efficiency, right? Maybe the factory is not operating as efficiently as it should, right? But generally, with a short holding period for work in progress is ideal. A long holding period for work in progress is not desirable because it is quite clearly a potential symptom of inefficiency in the production process. And it also means that there is also more possibility of working capital being tied up in the stocks, right? The longer that you take to process the stocks, it also means that there is more time needed before these can be converted, right, and ready for sale, as you can see here. Right, so long as these are still work in progress, it can't be sold, and working capital is still stuck, tied up in inventories. The last one, right, finished good holding period. The finished good holding period is quite important because it measures, on average, how long are finished goods held before these are issued, sold, or used. This is calculated very simply using the formula average finished goods or inventory, divide that by the cost of sales. The definition of this cost of sales is similar to what I mentioned earlier on. If you are taking the FIA program, then cost of sales will be defined as material plus direct labor plus production overheads. Also depending on what the question, on how the question defines this cost of sales. The whole fraction multiplied by 365 or 52, right, depending on whether you want it in days or weeks. The interpretation, generally a shorter finished good holding period is desirable because it means that the goods take lesser time to sell. There is lesser time that that the working capital is tied up in stocks, which is a good thing, right? There is also, as a result, lesser risk of spoilage. Now, stocks that are held for too long will tend to run risk of turning bad, right? Certain goods such as food can't be kept for long, and these will turn bad if they're held for too long. Certain things such as electronic goods like handphones, so those goods cannot be kept for long because there is risk of obsolescence, right? Handphones tend to age very quickly and tend to be outdated very quickly because of advances in technology. Now, the downside with having long finished good holding period, very simple, is that there is high risk of spoilage if you are keeping goods such as vegetables, food products, and so on. If, let's say, electronic goods are kept, there is also high risk of obsolescence, right? So, in short, holding period should be as short as possible. Okay, now we are going to use this very simple example to demonstrate how we calculate the three different holding periods. So this is a very simple example to give you a good illustration of how we apply the formulas. Okay, so let's begin. So in this example, ABC Limited produces a variety of goods, and they have incurred the following costs in the last financial year. The following shows the average inventory that are held over the same period. So there is the material, there is the work in progress, which is 40% complete, finished goods, which is $40, and your job is to calculate the holding period for raw materials. So let's begin. Right, so I have A, B, and C, three different holding periods to calculate. Let's begin with raw material holding period. So raw material holding period, according to my formula that I've explained just now, this should be calculated by taking the raw material stock, divide that by raw material purchases, multiplied by 365. I didn't mention whether to measure in days or weeks, but I assume that it's in days. But if you want it in weeks, then just change this to 52. Then you get the answer in weeks. Okay, so with that, let's just input this into the calculator. Right, that gives you 80 divided by 1000. That gives you a fraction, then multiply by 365, and you find that this gives you 29 days. If you wish to calculate this in terms of with one decimal, you can, doesn't matter really, right? So let's go on to the next one, which is work in progress. Now for work in progress, you have to be a bit careful because when you perform the calculation, you go like this. You have to take the work in progress inventory, divide that by, now watch, the cost of sales. Now in this case we have no idea what's the cost of sales, but remember in my earlier slide I mentioned that cost of sales is typically made up of material, labor, and production overheads, right? In some exam questions, you also see instructions being given such as this, right? Instructions such as stock holding remain constant, right? So such statements is to also confirm to you that the closing and opening stocks are actually equal, right? Because if they are different, then that will affect how we calculate the cost of sales, right? Okay, if you want to know more details about why, you can drop me a mail, but otherwise, usually when you see such an assumption being mentioned in the exam question, you will know immediately that the cost of sales is simply just 1000 plus 600 plus 300, which gives you 1009, right? And all you have to do to get your what you call that calculation for the work in progress inventory would be just 1009 times percentage completion and the whole fraction multiplied by 365. Now this assumption is very key when in this aspect where you have to calculate your cost of sales, because if they are not constant, that will totally affect how this cost of sales figure of 1009 is being computed. So beware of that. Okay, for those who are taking the FIA Foundation in Financial Management paper, it doesn't concern you. Usually the examiner would be kind enough to let you get away by calculating cost of sales as material plus labor plus production overheads. So the FFM paper tend to be a much simpler. Okay, so with that, then simply input this into the calculator, right? So you take the 30 divided by the fraction of 1000, the denominator of 1009 times 40%. So that gives you something, and multiply by 365, that gives you about 14 days. Now I have again rounded off the nearest whole number. It doesn't matter, I mean it depends on how you like to do it, right? It really doesn't matter whether you want to have it in 2 decimals or more. Okay, so we are done with that. Let's go on to the last one, which is the finished goods. Now the finished good holding period is quite simple. All you have to do is that, okay, I'm shifting this up so that there is more space, right? So what you need to do is just simply take the finished good stock divided by the cost of sales, which we found that is 1009, and we just take the whole fraction multiplied by 365. So a very simple calculation, not very difficult at all, right? You shouldn't have much problem doing this unless you are taking a very complicated paper. So this gives you exactly 8 days, right? Quite simple to do, right? So if you're trying to follow my workings, you can just take your time. If you need to freeze the video, please do. Okay, so that's done. So that gives you the 3 different holding periods: material, work in progress, and finished goods. Fairly simple. Okay, so what we're going to do next? Okay, right, so in working capital cycle, which I mentioned earlier on, and even working capital requirement, you also need to be able to calculate the collection period. The collection period simply means the average time that it takes for the business to recover any money due from receivables. Receivables are basically customers that have bought goods from the business but they have yet to pay. This is calculated using the formula of average receivables, divide that by credit sales, multiply by 365 or 52, depending on which whether you want it in days or weeks. The interpretation, very simple, right? A short collection period is generally good or otherwise bad, right? If it's too short, the bad thing is that it might offend customers. Okay, let me just emphasize, if it's too short, it could be a problem because it could affect customers, especially customers might be offended that they are pressured to buy and pay soon, right? Especially paying soon. So customers may not be very happy to know this. Now the good thing about a short collection period is that generally with a short collection period, the business benefits in terms of liquidity. So businesses are able to get back the cash earlier and they could use that to pay for their operating expenses. Now obviously, if the collection period is too long, it is really bad for the business because that affects liquidity. And not only that, the risk of bad debts are also higher, right? The longer the customers take to pay, there is also higher risk that they may not pay up, right? So there are of course other ways to look at short or long collection periods. Payable payment period. Now payable payment period simply means the average time taken to pay the amounts due to suppliers of goods and services. So this is calculated by taking the average payables divide by whatever purchases you have made for the period, right? Multiply by 365 or 52. The interpretation is quite similar to the earlier receivable collection period, right? A short collection period or a short payment period is generally not a very good thing, right? So if you take too little time to pay up suppliers, it's bad because it means that trade credit is not efficiently utilized, right? Imagine if the supplier were to offer you 30 days but you pay in 10 days. You're not making good use of that trade credit, right? And trade credit should be properly utilized because trade credit is usually interest free. So as far as businesses are concerned, they should take advantage of all this interest free financing, right? A longer collection period, a longer payment period is desired because it means that trade credit is well utilized, right? Well taken advantage of, but there is also another downside to long payment period. That is, if you take too long to pay up suppliers might get disturbed, they might get upset, they may demand for payment earlier, right? So a long collection period may not always be a good thing, so there is a fine balance. Now, so with that, let's look at a very simple example to see how we calculate the collection period. Collection period, as you can see here, we have the following numbers taken from the recent financial year for this ABC Limited. So average receivables is 230, sales is 3002. Now in this case, I didn't mention whether it's credit or cash sales. In such situation, we have to conveniently assume that it is credit sales. Of course, if there are more information, you can determine what's the actual credit sales. Let's input this into the formula that I went through just now. Average trade receivable 230 divided by sales of 3002 multiplied by 365, which gives us very simply 26 days. That's quite simple. Average payable payment period is a bit similar. All you have to do is just take 25, which is the average trade payable, divide by 1000, which is the purchase of materials, times 365. So that gives you very simply 9 days, right? So that's the calculation. Very simple, very mechanical, right? So if you were to take all of these numbers, right, and then whatever numbers that you have gotten, and you try to input them all together, right? Taking the assets, taking all the asset holding period, add to the collection period, minus against the payable period, that gives you the working capital cycle. So this is how you can string all these figures together to help you determine working capital cycle. Quite useful, right? So you might have gotten some other number, doesn't matter, but so long as you input the number into this calculation, you would also be able to derive whatever working capital cycle. Now you can also use the same template and use that to calculate instead working capital requirement, which is actually the same. Alright, so except that if you were to calculate working capital requirement, then the result that you have would be in dollar terms. Okay. Right, so how do we know if a certain amount of working capital is sufficient or whether it is not sufficient? Thankfully, this is not too difficult to assess, because what we need to do is that we have to identify and ascertain the current ratio level, quick ratio level. By assessing these two, it is possible to determine if working capital is too much or whether it's just inadequate. Inventory holding period is another one, right? That helps to assess whether there are too much stocks on hand, whether receivables are taking too long to pay up, whether payments are taking too long to be paid to suppliers, and others. By using this series of calculations, it's possible to assess whether working capital is sufficient, whether it's excessive, or whether it's just not sufficient at all. And the final thing is that aside from using this, you have to actually be able to obtain industry averages and compare. Right? By using the industry averages to compare, then that gives a clearer indication of whether working capital is sufficient. Prior year figures would also help, but industry averages are of course a lot more ideal because it gives a better sense of how the other similar businesses are doing. In the closure, so basically we have managed to cover the topic of working capital management and the various formulas like inventory holding, collection period, payable period, and then we'll look at certain issues on over and under capitalization, right? So what's the important takeaway? If you are taking this in the exams, it's important that you understand the formulas well, right? They are extremely important. Make sure that you know how to interpret, the different results, especially whether collection periods are too long, whether it's too short, issues such as this, right? And then, if you're taking the FFM Foundation in Financial Management paper, or even F9, you should be familiar enough and be able to discuss what's the issue with working capital being too little and too much. Okay? So with that, I covered this, and this is very academic. It's very much tuned towards students who are taking this, for the exams, rather than people who might be looking at this for business purpose. You could still use the same principles. They should apply in the same way. Alright, so meantime, I'm Will Chia, and thank you. You have been watching this on my YouTube channel. Appreciate your feedback, and